Good afternoon. How is everyone doing today? Hi, Pedro. Hi, Moses. Hi, Gias, Bob. How you all doing today? Thank you all for attending the session nice and early. If you can hear me okay, you can see me all right, put it into the chat. Let me know. I'm very well. Fantastic. How are you all doing today? Hope you've been trading well. Huge news tonight and also for this week. Mr. Fundamentals. Where did you hear that from, Moses? Where? Good morning, Pedro. We'll give it a couple of minutes before we get started. Today here with IC Markets webinar bonds, James Bond, talking about, guess it, bonds. You know, thank you. Thanks, Moses. Not quite a master yet. Still working on it, working hard on it. Again, if you are new, thank you all for attending the session. If you're new to the session, put it into the chat. Let me know where you're joining me from. If you're a regular, then put it into the chat and say hi. Quite an interesting session today. Hey Sumit, how are you doing? I'm very well. Good stuff. See a couple more people streaming in. Hey Simon, how are you doing? Hey Robin. Hey Diana. I'm doing well. Yourself? 1 more minute and we shall get started. Thank you all for attending early. Big news to be coming up tonight, but today we are talking about bonds. Hey, and while we're at it, and while we're giving that 1 minute, do you trade in bonds? Do you look at bonds? Do you trade in bonds? Let me know. Stocks was down and rebounded back. It was. Hey Neil. No, never. Are we still getting that side, that left side sound thing? Hey Bob. They checked it. I'm just wondering whether. See if I can tilt this. Wonder if it'll work a little bit better. Tried my strategy, got a pound US dollar yesterday. Fantastic. Hey, pound dollar was dropping today as well because of the news. Very bad news today on the employment numbers. If the sound is coming out only from the left side, it might be something to do with the speakers. I've heard of this issue recently. We are trying to, if it's still not fixed, I'll get the guys to check on it again after this session. Hey Desiree, how you doing? Good to see a lot of regulars here at the session. Happy that you're all here. Alrighty, let's get started. IC Markets webinar bonds, James Bond. I have one person, 2% saying that they don't trade with bonds, but it might be a good time now. Well, maybe not exactly, but I'm here to tell you more about bonds, how to look at it, how to analyze it, and if you're new to the session, drop it into the chat. Let me know where you're joining me from. If you're a regular, you know the drill. Ask me your questions as it comes up. Put it into the chat. I'll be happy to address your trading related questions as we get through this session. But before we get any further on, any information contained in this webinar should not be construed as advice and is presented as educational material only. International Capital Markets has not considered your objectives, financial situation, and needs, and you should consider its appropriateness to your circumstances. The contents of this webinar and any accompanying material are not intended to be a solicitation of funds or a recommendation to trade a financial product. What it means is that I will be sharing with you some possible ideas, possible, if you get some time, possible setups in the markets. And from what you learn with bonds that we go through today, please do your back testing analysis, make sure it fits with your trading appetite, your risk appetite, your trading strategy and methodology before you jump into any bond trades, especially, all right, from this session today. So quick questions is, do I trade stock? Oop, and I left. Well, do I trade stocks? Yes, I do. I do more of a buy and hold when I'm looking at the equity markets. Will you be covering on how to trade by looking at bonds in relation to the index or gold? I will be, not so much the index or gold, but more looking at bonds in relation to the currencies. Okay. Oh, Diana's back. Yeah, longer term investments, looking at buying and holding. I pretty much rebalance my portfolio, my equity portfolio, about every 3 to 6 months. Alrighty. So quite a number of things to get through today. What are bonds? Which are the most popular bonds? How do you interpret bonds? Bond trading strategies and trading bonds with IC markets. All right. Just an introduction of your host today. We do have a special guest as we talk about bonds, right? And as the title say, bonds, James Bond. Today we have James Bond, British literacy and film character depicted as a spy and masculine icon, designated as 007. We're not talking about that Bond, right? We're talking about bonds in the financial markets. So no, we don't have James Bond on the webinar today. It is me, Jin Dao. You all know me as Jin, or like JD, one of the external analysts here, investment analyst at the Everest Fortune Group, award-winning research team. I used to manage a multi-million-dollar FX fund. So I do look at bonds a little bit. I don't really trade bonds too actively. I do use it more as a, I use bonds more as an additional analysis to my FX trading. All right. So I do see a couple of questions there. What are bonds? But before that, just a quick answers here. Let me just adjust a couple of things. I start to read the Handbook of Technical Analysis. Mark Lim, do you know the book? I don't actually know the book. I'm also thinking I can tell you I'm terrible with reading about trading books. The books I do read about trading is more about psychology and mindset rather than the technical and fundamental analysis, and also strategies. What I tend to find that with books on strategies or technical and fundamentals, it can get quite dated. So I kind of struggle to apply it to the current market situations. Do you know about, I'm thinking about applying to CMT level 1 program next year. It's going to be a great challenge. That is a good one to do, the CMT level 1. I did my CFA level 1, but I stopped there. It was just a bit too taxing. So CMT is a good qualification to get. All right. And then, oops, I lost that. Lame question, is bonds and treasury yield the same? It is relatively the same. Bonds is the instrument, treasury yield is the percentage returns or the calculations, or which one implies treasury yield besides corporate bonds? Well, we're looking at the government bonds most generally. Okay, so that comes to the question from Desiree, what are bonds really? Here, bonds are or is a part of a fixed income asset class. What it means by a fixed income asset class, basically, let me just get this up. Okay, a fixed income asset class. So basically, what a lot of investors do, longer term investors do, is they buy into bonds and then they look for the regular fixed coupon, right? What it means is that when you buy a bond, it gives you a fixed rate of return. It gives you a fixed predetermined a fixed rate of return on a yearly basis or on a quarterly basis as a cash flow, right? So a lot of investors buy bonds because of that coupon rate, that fixed coupon rate, and then they use that return almost like a risk-free return because you're buying bonds, government bonds, so you're looking at good, safe bonds, right? And then it can be sold in the secondary market. So this is where we're looking at as well. It can be sold in the secondary market. When is it sold? When prices change or when conditions change, right? Financial market conditions change, which leads to yield being more attractive somewhere else. Then you would sell off your bonds to try and chase for the more attractive yields. So traders generally trade bonds on the basis of future interest rate expectations, right? That's why we talk about yields being more attractive. Let's say, for example, now, or maybe not now, like couple of years ago, you bought a bond, right? At maybe that pays you, let's say 3%, right? A US 10-year bond, and it pays you at 3% per annum, right? Right now, interest rates in the US is, with Thursday night, it might get to 4.5%. Just putting your money in the bank, you're going to get more money rather than buying the bond. So this is just by example. Okay, put quick example there. So if you were holding on to a bond that's paying you 3%, it wouldn't make sense. You would be looking to sell it off because it'd be better to sell it off, take the money, put it into the bank, and earn your 4% or 4.5%. Or, if you see that the markets are actually quite rising quite aggressively, then you could be looking into more active management of your investments. Okay, so this is a very passive approach. When you're buying bonds, you're looking at it as a fixed income asset, very safe, looking for that regular payment or regular coupon rate. Okay, how does bond, and the question there was about bond and bond yield, how does bonds and yield change, right? Firstly, it's the future interest rate expectations. If a central bank increases interest rates, right, bond prices will drop, right? As we're talking about here, bond price might be, I'm just randomly putting a number there, 500 at 3%, 500K at 3% per annum. If interest rates increases, right, then the bond price would drop. Bond price would drop because this becomes less attractive, right? This becomes less attractive. Let's say interest rate is now 4.5%, then your bond price will drop while yields will increase. All right. Hey, Fabio, no worries. Better late than never. Question there, will you rebalance your investment if you're getting older, like buying more bonds? I probably won't. I do have some bonds. I have bought some bonds. Those are just set aside, set there to forget. But I'm very light. My investment portfolio is very light on bonds. Okay, so in general, again, quick recap: fixed income asset, regular coupon payment, price and yield of bond is really determined by future interest rate decisions. If Fed Reserve increases rates, then you can see bond prices drop and yield increase. Right? It can also be a bit of a leading indicator into possible rate expectations. All right. So what we do, we have the US 10-year yield, or 10-year yield here. You can see just a standard chart. This is on TradingView. Right now, I just did this, is at 3.6%. Okay, how a lot of traders do, right? They might be trading the bond itself, but you can also apply it to your currencies. Right, this is how I actually use it a lot more. You can see that it goes in a relatively, not exact, not a perfect relationship, but it goes in a relative direction as yield increases. Right, you're going to see the dollar index get stronger, and then as it drops, you can see that also moving towards the downside. Does have a little bit of a, like I said, forward or leading indication, but always bear in mind that is never going to be exact. So you're not going to look at, you know, yield now going up over the last, I think this was the daily chart, then you expect the dollar to go up as well, because you see over the last 3 candles the dollar set right across. Okay, so you can use it as a little bit of an indication, but don't go looking at yield and then after that just going buy and sell straight away. All right, so what are the most popular bonds? Hey, you guys, for those of you, I think no one has said that they do trade bonds. But for those of you who have been looking at bonds, which bonds do you pay attention to? Which ones do you look at? Anyone? Apart from the 10-year, because I just showed you the 10-year, the US 10-year here. What other bonds are there? Put it into the chat. What other bonds do you know of? Let's just see. Anyone? Someone? All right. So there are a lot of bonds. This is the list on IC markets. There are, I studied a little but never trade. All right, there are a lot of bonds here. There's a 5-year, there's a 10, there's the 30-year. Okay, how do you actually look into which ones to pay attention to? This is all in the US as well. There's no perfect one to pay attention to. Okay, there's no perfect bond to pay attention to. This actually, if you look at it as a whole, right, you look at yield as a whole, it gives you a similar picture, but obviously when you look at a 30-year bond, it's going to have a longer time horizon. Right, it's going to have a longer time horizon compared to the 5 and to the 10. Okay, so this is the US ones. So I'll show you here. These are the US. So for me, I pay attention to the 5 and the 10, just to because I use it as a bit of an indication towards the currencies. So I don't look at the 30 years, a little bit too long of a time frame. Never traded bonds. Are they long-term investments? Bond are long-term investments, but I'll show you there are long-term approaches to it, short to medium-term approaches to it, and also scalping time frames in the shorter term as we use it towards the currencies. Okay, main things to pay attention to: the US bonds, right? The 5 and the 10 has a relatively good impact on the dollar, on the US dollar, in terms of the overall strength or the weakness. However, same thing on the UK, right? This is the UK gilt and also the Euro bonds. Okay, the Euro bonds. I don't know whether you remember the last time when the UK government had the whole tax issue fiasco where we saw the pound dollar drop significantly. New government came in and said, hey, to rescue the situation, they're going to buy 10-year gilt at unlimited amounts, right? So that's where they buy. When we talk about gilt, G-I-L-T, gilt, that's what we talk about on the UK bonds. The yen, right? The yen, JGB, always gets me tongue-tied when I talk about this. The JGB 10-year does have an impact, but the way the yen, or the way the Bank of Japan has been buying pretty almost unlimited amounts of bonds, has somewhat, from my experience or observations of prices, has somewhat minimized the impact it has had on the yen already. Right. So it used to be when they released the news saying that, hey, we'll buy unlimited amount of the JGB 10 years, or the 10-year JGBs, then you'd see the yen, fluctuate wildly. But right now, they have been saying that for a long time. Bond auctions have been running quite consistently, but we haven't seen that impact, or the immediate impact on the yen in relation to the JGBs. Okay, so there are a lot of bonds to pay attention to. It really depends on whether you're buying this in the short term or in the longer term, or whether you're really using these to give you an indication of how price for that currency could be moving. Sorry, got a bit of cough today. Never traded bonds. Are they long term? Okay, done that. Swap price is based on interest rates difference, right? Yes, Fabio. Swap price will be a little bit, is not what we're talking about today, but swap is the interest rate differences between the different currency pairs, right? Based on the different currency pairs, that's what we call swap price. That's calculated every day. And I think there's a rollover period on Wednesday where there's a larger swap amount being calculated as well. Alrighty, makes sense so far? Okay. So how do you interpret bonds? This is where we get into the meat of it, right? The yield of a bond is largely composed of two parts: interest rate and credit spend. Credit spend is highly risky. It does have, it fluctuates a little bit more. The main thing to pay attention to will be interest rates, right? So it's always, what we look at is, when we look at bonds, trying to scribble properly, it always looks at interest rates. Oops. Okay. Okay. Sorry about that scribble. There we go. All right. So you don't ever look to trade into bonds and just based on, like, oh, it's a US 10-year, where we think the US is going to be. Or even if you look at corporate bonds, you look at the, you just look at a corporate. You want to consider where is interest rates, the level of the future rates going to be, before you make your decision on whether you're buying bond, and then how it affects your yield in overall sense. Okay. Interest rate is the base rate for all bonds denominated in a certain currency and compensates investors for their baseline economic risk. Right? So always remember that bond is what we call somewhat of a risk-free instrument, right? Fixed asset, risk-free. Put it with, technically it is, but I'll put it with a little bit of an inverted comma, because nothing is really risk-free. So because it's risk-free, they get you the base rate, right? So if you're looking to sell, or the government is selling a 10-year bond now, they're selling you based on the current yield, or the current price, and the current interest rates, with anticipation that, hey, there's a yearly payment, there's a yearly coupon rate. So with that, it's a good, safe investment. But things happen. COVID happened. We had the high inflation rate climbing, and because of all that, we've seen the central banks increasing rates. This was, no one would have known this 10 years ago when we were selling a bond. So all that actually affected the overall interest rates. So that's where your yield would change. Okay. Very straightforwardly, you will see that, again, I sound like a broken record, but it's really just that one concept: the inverse relationship between interest rates and bond prices. Let's say at this point at this point where your bond was giving you a 4% return, right? 4% yield, and interest rates was at 2%. Okay, so this is bond, and this is interest. Oops, interest rate there. So at 4% and at 4% bond yield, 2% interest rate, you know, you would be happy to be paying that 1,500 for the bond. But as interest climbs towards the upside, right? As interest moves up towards that 3% level, that mid level there, and then you'd see that bond yield would drop. Bond yield would drop, and as yield drops, the price no, I mean bond price would drop, right? This is the bond price would drop. As price drops, the interest rate pushes up, staying at that level. Okay, so you can see here interest rate rising, bond price drops, yield rises. Okay, and then if interest rate falls, so if this actually goes this way and turns back down, then you see that bond price would go from 1,005 towards 1,000 and then push back up again. Okay, so it's really that relationship between bond price, bond yield, and interest rates. Any questions so far? Any questions so far? Nothing yet. Okay. Main thing you have to, I mean, take a picture of this, write this down, put it onto your, write it onto your notes. A rising yield is dollar bullish. A falling yield is dollar bearish. Okay. Under what conditions will interest rate and price both go down? Black swan events. Okay. There will be conditions where, or there could be conditions where interest rate and price goes down, but in the overall scheme of things, that could happen, but it'd be for a very short term, right? So we believe in a perfect market, you know, good information across the board. So we're going to see that as as interest rates drop or price both go down, it's going to quickly reverse back up, right? Straight away, as interest rate drop, we're going to see bond prices go into more, or bond get into more demand, prices will increase. Okay. Curious on how to trade this. Bob, will you be looking at longer term or shorter term trading? How is this calculated, the good price or the bad price to buy a bond? Okay, what I will probably avoid, what I would avoid doing is to get into bond price calculation. I can tell you that I did a master's in finance for 2 years. We spent a good 2 years calculating perfect pricing on bond price based on coupon rates, and different time periods and different interest rate levels. That's going to take me a lot longer than it's not even a 1 day webinar, in a 1 hour webinar, what we have left on a 30-minute webinar. All right. So I wouldn't be looking at, or rather, I wouldn't stress too much about trying to calculate a fair value for bond, or fair value price for bond. What you can actually be, you can actually trade the bond CFD, contract for difference, for what was I gonna say? You can trade the bond CFD quite similar to how we trade on MT4, looking at the overall direction and expectations. So it's very similar the way you trade it with FX or any instruments, right? You can look at the price candles, expectation that we're going to see. For example, let's say on Thursday we're going to see the US increase interest rates, right? So again, let's say here on Thursday, right, we're going to see interest rates increase, right? So if interest rate increase, we're likely to see bond price fall, right? We're looking at a 50 basis point rate hike. All right. I will pre-warn you first that this is probably priced in already. So you guys don't go entering a trade right now. The disclaimer still applies, right? But using this as an example, this might be priced in already. But we're looking at Thursday, interest rate increase likely with 50 basis points. So we're going to be expecting bond price to fall. So what you could be looking at, I'll just fast forward a couple of slides and come back to that before. All right. So you could be looking at active trading, where you'll be looking to sell the 5-year treasury note, right? You'll be looking to sell the 5-year treasury note because, hey, we're expecting interest rates to increase, right? We're looking at interest rates to increase, so bond price should fall, looking to sell it down. Is there a correlation between bonds and gold? I mean, not just technical or graphical correlation, but fundamental. I haven't really done too much on the technicals, so that's a good thing. But fundamentals, there is a little bit, right? As usual, because it's all considered as a little bit of a risk off or risk on asset. You know, when you think that things are too risky, you're looking for the safer instruments. So when it comes to the safer instruments, what we're looking at bonds, we're looking at safe haven commodities or safe haven currencies. Okay, so there is a slight correlation, slight positive correlation between bonds and gold, not perfect though. Okay, so coming back to this example again, as we expect interest rates to increase, we expect bond price to fall, then what you'll be looking at is to sell. In this case, in this example, sell 10 contracts of 5-year US Treasury note at 120.25. So your opening price 120.25, 10 contracts at 200, right? This is your contract size. So you'll be looking at 240,500. When you close it off, given that interest rate increases, price does drop, you're closing it off at 118.32 at the same parameters at 236,640. So gross profit would be 240,500 minus 263,640. You'd be looking at a $3,860 profit. Okay, so I see a lot of questions there. That's why I skipped ahead. The active trading of bonds, you'll be able to do it on your MT4. I'll show it to you shortly. On your MT4, as you look to take advantage of expectations for rate increases or possible rate hikes. Why I had a big disclaimer there, pre-warning you all about the interest rate decision on Thursday. Okay, so coming back to this, all right, because like I was saying, this situation is probably priced in already, right? This situation on Thursday, 50 basis point increase is probably priced in. What you want to pay attention to on Thursday is the future, right? So you're looking at bond prices, not about this interest rate increase, you're looking at future rate increases. What I mean by future rate increases is the Federal Reserve going to talk about slowing down further rate increases? That's one thing to pay attention to. Or no, slowing down the scale of future rate increases. And then more importantly, what is the, okay, take a note here, terminal rate. That's the main thing I'm paying attention to on the Fed Reserve interest rate decision on Thursday morning, 3 a.m. GMT plus 8. All right, so that's the one I'll be paying attention to. It's not so much the interest rate decision because we know that's going to happen already. We pretty much know that they're most likely going to scale down on future rate increases, but what you're going to look at is the terminal rate. That means the final interest rates, because that's going to have that impact on bond prices and bond yield. Because if they say that terminal rate is going to be higher than previously expected, then we're going to see bond price most likely drop and yield rise. All right. make sense so far? This might be a absolutely new concept for a lot of people. So if you do have any questions, let me know. And hey, if you at the end of this session, if you do have any questions as well, please feel free to reach out to me. And I'm quite happy to share with you further on with this topic and any other topics as well. All right. Let's see if there are any questions coming up. No worries. Good stuff. Okay. So you can see here, right? So like I was just telling you about 10-year yield, and this is with the US Fed Reserve interest rates. Okay. Interest rates has been slowly climbing up, and then since the 2019, 2018, 2019 period, we saw it turn back down, set at 0 in 2020, all the way to now, and then it's pushed back up. You can see that with yield. Just be extra careful. It's, as like I was saying, it's not always going to be that perfectly perfect relationship there. All right. You can see here, although yield went up, right? Although yield went up, interest rate actually still set right across, right? Interest rate still set right across. So why did yield go up during this period between 2020 and 2022? Any idea? Any idea why yield went up? Right, it went from that almost 0.5% pretty much to, let's say, about just under 2% during that period, despite interest rates holding right at the bottom. People were expecting rates to go up. Yes, one thought is that people were expecting rates to go up. And second idea is that during 2020 to 2022, hey, we saw that as the pandemic period, right? We saw this period as a pandemic period. What would you do with your money? Right, yeah. Fear of recession, you're looking to put it into a safe asset or safe fixed or safe financial instrument, and if at that point in 2020 where markets were closing, economies were closing, shutting down, no air travel, nothing was happening, and I told you that, hey, you could get in, you could be buying a bond that will pay you 1%, right? Hey, that might sound like a great investment option at that time. And even if it came to telling you that buying a bond at pay you a 2% coupon would sound like a great investment option at that point in time. Okay, so that's why we saw this climb despite interest rates sitting right across. So that's one point I want to highlight to you or reiterate again. It's not always going to move in tandem. There are other factors that will contribute, not just interest rates, as much as interest rate is the main driver. Okay, and then you can see since the Fed Reserve have been increasing rates aggressively right now at 4%, by Thursday might be 4.5%. We saw this push very strongly, even broke above that 4% level back at this period where interest rates was at 3%. Okay, so at that point they were actually expecting that rates might be a lot higher than 4%. We were looking for this to push up, but with the recent talk from the Fed Reserve about slowing down on future rate increases, that's why we've seen yield dropping back down again. Okay, and like Simon said, right? Simon has been saying recession and fear. The treasury yield or treasury term spread, 10-year bond rate, does have a little bit of a well, not a little bit, quite a good indication towards how probability of a recession comes around. All right, so you can see that every time we see the 10-year bond rate drop quite significantly, we're going to see that risk of a recession climb, right? That risk of a recession climb every time we see it drop. So that's why this is I believe this is a live, I just got this from the Fed Reserve, the New York Feds. This is a live chart, or most recent chart, and that's why we're hearing that whole fear, that constant comment about a recession in the US, right? And not just in the US, if we see that recession is possibly going to apply right across the board to a global recession as well. So that's quite an alarming situation that we're in right now. Okay, so unfortunately, I can't take out this link, but there'll be something interesting to look at. You can catch it there. So, like a lot of you have been asking, interesting things, right? Interesting idea, interesting concept, but how do I trade it? How do I trade it? Like, I think Diana was asking me, do I buy bonds? There is a way to do it. You could just buy bonds as they get released. You buy it and you hold it to maturity, right? I do have some corporate bonds that I bought. I have, I think, a couple of government bonds as well. You just buy the bond, you buy the individual bonds, you hold it to maturity, take the cash flow, a regular cash flow. It's almost like receiving interest on your money, right? Cash flow for the bonds can be used to fund other income needs or reinvested to your bond portfolio, buying more bonds or other asset classes. Okay, so that's a straightforward method. Buying and holding. Is the term fixed income the same as bonds? Because that's what some bankers are trying to sell to me recently. Yes, fixed income. There are other fixed income asset class in the asset class. There are other fixed income instruments in that asset class, but bonds is one of the instruments in the fixed income asset class. All right. Just be careful what you buy. Interest rates could be heading higher, or could be staying high. So just watch out on the if you're looking to buy longer term bonds. All right. So straightforward. I think this is you go to your bank. You wouldn't do this on your trading platform. You'd be looking at this on banks to look to buy and hold on for the super long term, right? 5-year, 10-year bonds you'll be looking to buy and hold. What else can you do? Like I was just sharing with you, you can do active trading. Again, the example, expecting interest rates to increase, bond price should fall. You'd be looking at, let me just scroll straight through, right? You can see this is on MT4 on IC markets, right here, this section here, right? So you should be able to see it on your MT4 as well. I took this off my MT4. These are all the 10-year bonds, 30-year, 5-year, UK gilt, and the JGBs. Put it across, and then you see your prices there. With that expect, you can trade it as how you would normally trade your other currency pairs or commodities. Okay, this is the 10-year. Currently, this is on H4 time frame, the 10-year at 138.55. So what do you think is going to happen? What do you think is going to happen here? I'll give you some time to think about this, right? Do you think it's going to go this way towards the upside, or is it going to reverse? Is price going to reverse back down? Put it into the chat. I'm going to come back to this slide. This is the last slide. I'm going to come back to this slide. Let me know, do you think that at 138.55 in the medium term time frame, will we see the US 10-year head towards upside or the downside? Okay, I'll come back to that. Put it into the chat. All right, so that's the example there. We've gone through that already. Bear in mind this point here. All right, bear in mind this point here. For bonds with a contract size of 200, it means that every 0.1 move in the bond CFD is worth $2. Right? So slightly different way of calculating in terms of your pips and the dollar value. We don't call it pips, but dollar value of the move. Every 0.1 is worth $2. This is how I would, or how I use my look at the bonds chart and use it for my trading. Demand for bonds increases when investors are concerned about the safety of their investments. Flight to safety, bond drive prices higher, pushes you down. Like we were just talking about, when back in 2020 there was a recessionary fear, markets were closing, pandemic fear. Okay, increased demand for less risky instruments such as bonds, and safe haven currency pushes their prices higher. So how I actually use bond yield and currency, right? So we showed you the 10-year bond already. We showed you the sorry about that. We show you the 10-year bond already on the US 10-year. This is the UK 10-year. Again, you see that move, right? A similar move. This is the pound dollar on the same time frame. as as the UK 10-year bonds drop, you see the price on the pound dollar drop as well. In this case, again, a bit of a special situation. Saw a big spike up and then back down again. This one less so, right? I'm always keen to focus on how it doesn't work, just because I'm super afraid that you would just, look at how 10 years moving and then just jump into the pound dollar. So just be extra careful there. Have you back tested bond and yield prices in regard to reaction of Fibonacci confluence? I haven't tested that in relation to the fib levels, right? I haven't tested that in relation to the fib levels. I do look at I don't think that bond prices, actually I should actually, but I haven't really tested it because I don't think that bond prices or bond yield move based on the fib levels, right? It's more based on the expectation of the fundamentals, how GDP is moving, how the inflation levels are, and how interest rate expectations are going to be. All right. So, like Moses said, I'm more on the fundamentals. I do, yeah, pay attention to the fundamentals to translate it towards how bond yield and bond prices could move, and also then influence the currency price as well. No worries, Simon. So when the government says it's buying bonds, what's the implication? I get confused sometimes why they need to buy bonds. Okay, so when government buy bonds, basically what happens is that they're actually sorry, my voice is going. When government buy bonds, they're actually pushing money into the markets, right? So because who are they buying bonds from? They're buying back bonds from people who bought it from them before, right? They're buying back bonds from people who bought it from them before. So when they buy bonds, they're pushing money into the markets. They're pushing increasing supply into the markets, currency supply or monetary supply into the markets. That happened back in 2000 and it happened a lot in 2008, 9, 10, 2008, 9, and 10, where we saw the global financial crisis. All right, so they need to push a lot of money, increase the supply to try and weaken the currency a little bit. That's the only way they could have done it, by pushing money back in. So they're looking to buy bonds. All right, Desiree, hope I answered your question there. So that's the UK 10-year relationship with the pound dollar. You can see sitting right across, little bit of a downside move expected, but the pound dollar sitting right across. This is crucial. You can see it's been sitting right across over the last couple of days or even weeks, because bear in mind, all of you, Thursday we have a lot of central bank news to be released. We have the US FOMC Thursday morning, follow on with the Swiss franc or the Swiss National Bank in the afternoon. In the evenings, we have the Bank of England and then the ECB, all with their interest rate increase or expected interest rate increase, all looking at about 50 basis points rate hike. So that's why we've seen price push up, sitting right across there. Could be quite interesting if you're looking to trade bonds, but you're still, I would say, you're still quite new to this topic, especially if you're looking at it for the first time today. So it might be something that you want to look at on Thursday. Have a bond, have the UK 10-year, have the US 10-year open, see how price moves as the interest rates decision come around, see how the impact applies. Then you get the experience for possibly into next year. You could be adding trading bonds as one of the other instruments you trade in your portfolio. All right. This is the EU 10-year with the euro dollar. Again, you see this has a lot less of a correlation, you see, down here pushing towards the upside, in this case pushing towards the downside, and then not really moving in that similar fashion, because for the eurozone there are a lot of other factors such as, any idea, other factors such as the Russian and Ukraine war, Ukraine conflict, oil prices affecting it as well. So a lot of other factors affecting the euro dollar, and these are big shocks to it as well. That's why we see that there's not as good a relationship between the euro 10-year and the euro dollar. Alrighty. So when you look to trade bonds with IC markets, bond markets, you look at the CFDs. Like I was just showing you on the MT4 there, you could be just dragging this right across to your charts. Again, let me see how many of you have answered this. Let me see. Oops, where was it? I lost it. Touch 139. So Fabio says touch 139 first. So 139 will be about there, right? So you think that's going to push towards the upside. Anyone else? Down, double top formed. So double top formation formed. Anyone else? Okay, so remember, I'll scroll back. This is the 10-year price. Okay, I'll scroll back. Only 2 of you answered, so I hope more of you would answer. Again, as I look at this part, remember that if interest rate increases, we could be looking at bond price fall. And also, if the terminal rate is expected to be higher than expected, we're going to look at possibly bond price falling. So coming back to the chart here, I wouldn't say that because it's a double top, but I think that, as it sits at this level 138.55, yeah, I think that if they do come out and say that, terminal rates could be higher, or even we might see a surprise from the Fed Reserve saying that markets or financial market or economic performance in the US has been quite strong. Economic data in the US has been surprisingly resilient. It might be doing a surprise markets with a 75 basis points, not 50, or they might even talk about not scaling back on their interest rates decisions or rate hikes, on the scale of rate hikes, and we could see price drop back down. Okay, again, usual disclaimer applies, but just be extra careful with that. Yeah, hawkish report. Bob says also a head and shoulder and double top, probably towards the downside, and the Elliott wave. I will not be able to draw you the Elliott wave. I'm terrible with that. So I'll take your word for it, Bob. Okay. So at this point, as we come to the end of the session, do you have any further questions on bond? I know this is really a snapshot view, right? So I don't expect you to be looking to jump into any trades. I hope you don't jump into any trades at this point in time. If you had a good session, you found it interesting, useful, good information, please do me a big favor, put it into the chat, let me know. And also test it out, right? Test it out. Get onto a demo account, try it out, or just put a line. So what I like to do is I'll put a line at that point there, and then see what happens. Have an expectation, see what happens on Thursday, see what happens on to Thursday afternoon. Where does price head towards? Good way to back test or forward test a strategy or a new concept. All right. Gonna do advanced bonds class. I don't think there's any further advanced to go. Probably more time on how to calculate, but I don't believe that knowing how to calculate bonds at this point in time will be super important for you guys. All right. All set is awesome. Thank you, Sumit. Very informative. Thank you, RJ. Good session. Not sure if I'm going to do something with it. I understand, Bob. Test it out. Look at it for now. Awesome as always. A lot of new information. Thanks a lot for your time and dedication. You're most welcome, Pedro. Advanced class for Forex. We could do an advanced class for Forex. Thank you, Moses. We should do an advanced session on fundamentals. I'll be looking forward to that. Clear your thoughts on bonds. If you do have any further questions, please feel free to reach out to me. Let me know. I'll be happy to guide you through your trading journey, not just on bonds, but on any other topics or interesting levels that you want to talk about as well. Yeah, well, I can't cover all strategies. I will pick up on Elliott Wave sooner or later, but it's gonna be one of those things. Advanced session is interesting, but I will use it. I understand, Robin. No worries. Alrighty. So with that said, trade well, trade safe. Please, please, please remember, big news ahead. And tonight, GMT plus 8, 9 p.m., we have the US CPI data to be released. So if you have any trades, please make sure you try and close it out. Stay neutral with this big news to be released tonight, GMT plus 8, 9:30. I just literally, while this session, I just closed out my US yen for a small profit. Just didn't want to hold on to it as we head into the news period. With that said, trade well, trade safe, take care now. Bye bye. See ya, Bob, and everyone else.